Okay, just to kick things off, many of you know me, Andy Arduini, Senior Managing Director with Huntington National Bank. Today's topic, obviously tightening regulation and what that might mean for banks. I'm delighted to share the stage with Anna Arsov this morning. For those of you that are unfamiliar with her, she leads, correct me if I'm wrong, Anna, you lead coverage. Actually, your title is your head of private credit for Moody's Investor Service, as well as co-head for financial institution coverage globally. She's in charge of analytics and issuer coverage for private credit, as well as the leveraged loan market and the securitization markets. And prior to that, she worked at a number of leading global banks and executive level credit roles. So again, delighted to have her, brings a wealth of experience relevant to the topic today. Before we kick off, I want to talk a little bit about the sequencing of how we're going to do this. Anna was kind enough to put together a deck that she would like to present to all of you. After that, we're going to make it interactive. We have some Slido questions that we think will hit key topics that will be on many of your minds. And then finally, as time permits, we'll hit any questions that you may have that we didn't cover in the preceding information. And with that, Anna, the floor is yours.
Thank you. I think that there was supposed to be a clicker somewhere.
Yeah, we're missing a clicker.
Oh, it's on the stage?
Yeah, if you want to go to the podium.
Yep. Maybe, let me see if I can see from here. No, aging, blindness. My glasses are in my bag, so I'll stick here. I think you'll appreciate that. So let me see how we get here. So basically, actually it's interesting. This is I don't need to tell you, I think not many people would disagree with me about the title of the presentation, Regional Banking Under Pressure. And to give you a sense, thank you for your introduction. I'm really honored to be here. Andy has been wonderful, and I said great planning because this took quite a while as well. A lot of prep sessions. I see being here how well organized, and I saw the topics that you guys were discussing and continue to discuss this week, which is great. I was running all bank ratings. I was a global head of bank ratings actually until later this year when I got elevated to a FIG head, which means basically all banking, non-bank finance, and insurance, in addition to my private credit kind of research focus area. So that meant that I pretty much did not sleep last year during the bank crisis of March and April. So a lot of that, we're trying to be kind of forward-looking here as well, but I want to be also interrupted and challenged about a lot of the things here. But certainly we did not have an easy year from a regional banking perspective. A lot of the slides here that I'm going to be talking about are relative to really about the mid-sized banks. I want to do a qualifier that we think that the large banks, which a number of you are part of and members, a little bit much more, I would say, insulated from the pressures of the small banks, and I'll talk about it why. So with that being said, let's start. So what is, I think, 2023? You know, what ultimately happened, and I think when I put this slide, actually it was a couple of months ago, and we didn't need to hear Powell, obviously, last Wednesday, that we still have inflation issues, and they're still bugging us from a rate policy perspective. And ultimately, with 50–60% of the income, particularly for regional banks, comes from net interest income. How you manage interest rate risk, how do you invest, how do you kind of do asset liability management is key for banking. And of course, inflation on a surprise does not take us necessarily to a very predictive rate outlook. So what happened last year, I think, was ultimately inflation predictions were wrong, and then a lot of banks were caught short, for lack of a better word, on managing that interest rate risk. Interest rate risk management was very poorly managed, particularly at the small banks, and this is the risk of kind of bifurcated regulation that exists in the US about particularly this item between the large banks, how they capitalize for interest rate risk, meaning losses in the securities books versus the banks that are, sub 200 billion. And unfortunately, some very good banks with great franchises were caught short, and no same bank crisis is same every year. We had a period where we were so focused on credit. And a lot of the banks that we think about, is it First Republic or is it even Silicon Valley Bank? They did credit as good as one bank can do. The problem was this risk this time around was not in their traditional how we think about risks of bank balance sheet, but it was really about interest rate mismanagement. And if you think about it with AAA rated securities. So that's what I'm saying. What is the kind of the key risk management lesson? We had a recency bias. Whenever we think about risks, and as risk managers, I'm a former risk manager at the banks, it's always tending to think about how the last crisis play out, but that's not the case here. Over-reliance on the forward curve. I mean, the forward curve was saying we're going to have rate cuts. That did not happen. Even the forward curve was saying we're still going to have 4 rate cuts this year. Obviously not happening. Our current view is that likely it's going to be potentially 2. But there are pundits out there and economists who are saying none this year based on the most recent economic data. The other thing, that contingent funding plans was not something that mid-sized banks were focused on. I spent a lot of the time, I started at Moody's being the managing director responsible for the globally systemically important banks. So I really spent a lot of time with the GSIBs, if you will, globally on any topics of treasury. And then last year when I had to join my team with the smaller banks, a mid-sized bank, I saw that discrepancy of contingency funding planning and thinking about risk management, thinking about quality of deposits, that the large banks simply had to be attuned with the LCR and the proposed NSFR for the last decade plus, and that simply was missing in this mid-sized bank cohort. And then with that, economic capital, which is the last bullet here, which is really a capital, when you take out this through capital losses that they don't have to still provision for in their capital on their securities books, which are roughly around 400 billion, still on US banks' balance sheet, obviously creates a challenge. So where are we now? As I said, last mile of inflation will be harder. I say we are in a calm. I don't want to say calm before a storm, but a deposit outflow, which is a very concerning story of last year, is much more stable. But it doesn't mean that it will continue because the Treasury is probably on a pause, and we still have uncertain policy from a macro perspective, where how far the rates and the competition with Treasuries is going to remain relative to bank deposits, and greater tension between Fed policy objectives. Now that we have obviously pretty decent economy, should they continue on quantitative tightening as well, so to subdue inflation? But that quantitative tightening obviously creates pressure with banks' earnings. And the loss forecasting models, as I said, we don't really have a loan performance data, most recent one, in a high rate environment. I think a number of us, when I started in the industry in 2000, normal rate was 5%. But if you think about now that kind of I'm in a different age zone, nobody really remembers that as the new classes of either risk managers or underwriters, what it means to actually underwrite in a high rate environment. And the problem is, do we have that recency bias of thinking 5% is high, but actually, as Jamie Dimon said in the last earnings call, it may go higher from here. So what does it mean for risk management? And then, of course, things on our mind that are always out there in a more electronified world with digital banking, now AI, thinking about cyber risk, and particularly for you in the payments industry, this should be always on your management team's risk horizons. So this is the scorecard of the US banking system outlook. We're happy to distribute as well this deck if you wanna. This is something that's published. Every year we publish a scorecard and prediction, if you will, of the US banking system. And we don't have anything green, which means nothing is positive necessarily. And this, again, does not cover, it's not specific for the 5 large banks. This is really more for the cohort of the mid-sized banks. But what we're saying, the operating environment actually is stable, meaning that we are having a constructive economic outlook. Capital, which is a very important, obviously, factor for our scorecard. On one hand, we were expecting higher provisioning, obviously, and losses, considering we've literally lived in a Goldilocks environment, absent the interest rate risk or the CRE, which I'll talk about. So, but nevertheless, the banks have to prepare for higher regulation, which means that they're raising capital, although maybe economic capital is lower because of the interest rate losses that they have still on their balance sheet. So, but net is stable. And then another stable is how we think about government support. Obviously, we only include government support in the largest banks. However, we spend a lot of time sometimes when we were notching with the banks like First Republic, for example, how do we think about the deposit support? And obviously that happened. So there was some interesting notching that we thought about of deposits being protected, which actually, end up being true. I'm not going to bother with technicalities of that, but obviously it was something that they had to think about last moment, but it's not provision in our, if you will, statutory banking laws. So what is negative? And I'll spend a lot of time here what my concerns and my team's concerns are. Asset risk, and it's really more here about commercial real estate. Think about 40% of all commercial real estate is set on regional banks' balance sheets. And obviously here, there are some positives in commercial real estate, but for us, the biggest focus is office. And if you look at the provisioning that has happened in the US banking system, particularly this last quarter, has largely been for commercial real estate. And currently now on average, there's a coverage of 8-9% of CRE from a provisioning perspective, which is, good coverage. But if you think about our CMBS colleagues, they actually think that probably for office, the right stress is actually 40-50% of book value of where the loans are being held. So that means that there is much more stress coming, particularly if you have an office concentration. Profitability, well, think about an environment where whatever net interest income you were actually benefiting from, that has capped. And now you cannot really reprice your books in a slow loan growth environment. You cannot really grow your CRE book because you have too much of it. And on C&I, as we know, we have very weak demand still. So a lot of small banks do not have credit cards. And then auto is pretty much the only area that has been growing that most banks would have. But really, the only kind of areas that have been growing has been exposure to non-bank financials and credit cards. So if you don't have those businesses, supporting NBFIs or supporting franchise supporting NBFI, or you have credit card business, your loan book is largely flat, which means that you cannot really reprice for this high rate environment favorably, which impacts your profitability going forward. And funding and liquidity, we still think it's negative. The deposit stability is out there, but it's much more expensive to keep those deposits. So how do we see from a rating perspective today? A number of you obviously part of this rating construct, and we talked to your treasurers. So we changed the US median, the US banking system with the highest rated banking system in the world together with Canada. And Singapore, much smaller system, and Australia. Those were the highest rated systems globally. So now the US is still one of the highest rated systems, but not the highest. We've changed the median, what we call standalone baseline credit assessment without any kind of government support, technical support in your rating. That used to be A3, now it's Baa1. And that largely because of the move of the regionals. Actually, the large banks, some of them during the crisis actually were upgraded. Like Bank of America, for example, was upgraded, just to give you a sense. But we did have a number of downgrades in the mid-sized bank sort of level. But we still have significant portion of the bank universe on negative. Again, no large bank is on negative. Meaning in the US. So, 35% is basically of the system is a negative outlook. This is just some more detail around kind of the baseline. This is the whole point that we have still very high reserves on banks' balance sheet. What happens if, the money market funds start fighting for these reserves and take out deposits from the system, which means that they will add more pressure. So again, this is all about rate play and where do we end up and what the conviction is. And we don't think that those pressures are over. And by the summer, we may see some more pressures and competition with money market funds, which will drive, obviously, flights of deposits outside of the banking system. But we still think in a more orderly way, not like the distressed ones that we were seeing of last year. So this is very interesting. You can see by deposits, by income category, the only deposits that really are growing is by the top larger earners, which means that the consumer in the bottom sort of 40% in particular is really hurting from this inflation. So there's a bifurcated, not only regulatory system in the US, one for the banks, so big banks, one for the small banks, but also there's a bifurcated consumer. You keep hearing that the consumer is doing well, but actually that's not necessarily 100% correct. Yes, the consumer that's the top 20% is doing well, the bottom 40% is really suffering. And you can see that they've actually spent their kind of COVID savings and all COVID benefits that they got from the government. Now they're tapping into credit cards. So this is the big story that's still weighing on banks' earnings and on banks' capital. Basically, you can see how the pre-tax unrealized gains or losses from securities holdings. As I said, because there was so much influx of deposits, roughly 3 trillion deposits end up on balance sheet, the banks couldn't match to that much loan growth. So they end up parking this with high-grade securities. but they parked those high-grade securities that they were basically purchased with 2%, 3% return. So now, considering where the yield curve is and the treasury is earning 5%, we still have a lot of losses, as you can see. Although those securities are maturing, we still have around $400–500 million of losses on banks' balance sheets that the only way for those to squeeze and not wait on capital and earnings is going to be, one, different rate environment, and number two, time, meaning this average maturity is roughly around 3.5 to 4 years for this book. So we're still a couple of years away from basically reinvesting these securities at a higher rate, and then until then, this will weigh both on capital, on economic capital, but also on earnings on banks' balance sheet. So you can see how dramatic change this was for the industry over the last 2 years, this rate environment and the speed of tightening. And what does this mean for profitability? Net interest income is basically flattish. It declined still in the first quarter, although the rates stay high because they simply, without loan growth, the banks cannot really reprice and get benefits from this higher rate environment. The reserves, as I said, we're not concerned about reserves that everybody has been building, and there's ample coverage for non-performing loans unless there is a much bigger shock in CRE outside of office. And then, we have, all the regional banks were building capital. Even the large banks have been building capital because of Basel III. And but they're probably, when you compare the US system relative to particularly the other developed systems like in Europe, we're still below capitalized than some of the larger high-grade systems. So there is more to go here. So the only thing I would add is, let me see if I can go back, what happened. The only kind of other point I wanted to talk about that we are focused on is the private credit market. I think all of us, unless you sleep, under in a cave, you probably have heard that every single day there is something about private credit, and there's something about disruption in private credit. I'm not going to spend a lot of time. I would like to take questions on that, but this is the foundational slide that I want every investor, every banker to understand what's happening. If people ask me, how do you define private credit? Listen, private credit is any kind of non-bank, basically provisioning of credit into the economy. So technically that includes anything from Quicken Mortgage to OneMain and anything in between. However, what the fascination, and we've had non-bank financials and private credit in the United States for decades, and that's what makes our system highly diversified and typically highly effective, and for the benefit of ultimately the customer. What the focus now a lot in the media and why we established a private credit analytical franchise is because the financial sponsors have grown so large over the last 15 years, and you can see that something called dry powder, which is raised but the undeployed capital by financial sponsors now is $2.5 trillion. So if you think about $2.5 trillion that has to be deployed in the economy in various strategies, that needs to be levered. So that leverage can come part from the banks, as we know, and largely comes from the broadly syndicated loan market, which is kind of the investment banks that facilitate. But also, the investment banks do not really have the risk appetite to provide, and the market is kind of glitchy sometimes based on the rate policy. It closes, it opens. So the private credit lenders basically are just another form of alternative asset manager that raises capital to fund this leverage loan cycle, if you will. So that's the narrow definition, and we think that private credit in that sense is roughly around $1.7 trillion globally, from which $1 trillion is in the United States. And the largest piece of this is direct lending, which is around $750 billion. But to give you a sense why everybody's focused, because that $750 billion of C&I leverage loans on private credit alternative asset managers' balance sheet was only $200 billion 5 years ago. So this has grown significantly, caught eye of every investor, every newsmaker, rating agency, including regulators. I was just in DC 2 weeks ago, met with a number of regulatory pundits globally, including policymakers across the pond, and everybody's focused on this topic. How is this going to continue growing? What does it mean for the banks, et cetera? And particularly as private credit now is moving from just direct lending into the leverage space, but it's moving into partnership with the banks. It's moving with ABS, asset-backed financing, warehouse financing. So they're here to basically touch every portion of your business, if you will. This is not going to happen overnight, and first it's going to start with partnership, and it's going to continue growing until regulations potentially pick up. So I will leave you with that. I can answer many more questions, but obviously from our perspective, we rate these alternative asset managers, we rate these structures, we've seen increased demand, and a lot of these assets end up actually not on banks' balance sheets, but on insurance balance sheets. So this is why the regulators are really focused about where the insurance industry risks are in this space. So I don't know how I did. It was a whirlwind of large topics, but happy to join.
Yeah, nice.
Thank you.
Nice job, Anna. As you could probably tell, I think we could have spent the entire morning on this topic. I mean, there's a lot of depth of coverage and things to consider. So what I'm going to do, I'm going to call a bit of an audible. We had 3 Slido questions. I'm only going to hit one of those. I see some great questions coming in. I don't want to make sure everybody has the opportunity to engage with Anna directly. But the first question that I want to hit via Slido is I look at your deck, right, and the words uncertainty, choppy waters come to mind. We look at the regional bank crisis that occurred last year, right? I think we expected to see regulation. I mean, the issue at its core was funding structure, it was liquidity. I personally was surprised when the regulator went to the capital toolkit. I'm like, these don't seem to match, but nonetheless, we have things like Basel III Endgame that we're now considering. Now, an obvious way for banks to build capital is through earnings, right? I mean, that requires a conducive operating environment to do so. You kind of gave us your view, kind of looking down at the banking industry. With the first Slido question, I'd like to get the view of the audience, right? So we have the first quarter now behind us. So what did you see in the market? That's really the essence of the question, which, can you cue the question for us? So yeah, if you could answer this question and let us know kind of what you're seeing, and then Anna, I'm anxious to see your potential response to what we learn here.
A lot of optimism here, good. You need to face customers, you need to be optimistic.
Well, I mean, in full disclosure, I think most people hear Anna sell things, so
that's what I'm saying. This
we're
is not
optimistic in nature.
Right after this, I was saying to Andy, I'm presenting to the risk offside of one of the GSIBs virtually, so I'll see. I think they're much more concerned because this is the risk managers.
Yes, I mean, I'll be first to admit that would not have been my response. I am quite surprised to see north of 60% thinking that 2023 is better than last year.
Well, anything is better than March and April of last year.
Good point. If this is on a year-over-year basis, that's the appropriate response. But I fully anticipated that we would have more concern in the audience than we have. I mean, what's your reaction?
Look,
this surprises me.
It's a very, and I appreciate it's a relatively broad question. What I would say is it's better because it's more stable.
Okay.
The issue is where is loan growth going to come, and are we going to have surprise shocks from a monetary policy? So Powell seemed to say, you know, kind of you'll read the pundits who read the presses of for years and try to interpret a chair of Federal Reserve. They didn't leave another rate hike as out of option. You know, more interest rate hikes is not going to be great, as you just saw from a capital perspective, particularly for the regional banks. So that means that when you're supposed to build capital, and you are basically exposed to more losses on your unrealized book, and you cannot really reprice because there is no really loan growth coming in a good way, good loan growth. So where are you going to end up, and how are you going to have to pass a lot of that next 25 basis points or whatever it is coming to your customer? It's not really that good from a profitability perspective. The only good part is maybe you're going to not be reserving as much if the economic outlook is good. So I would say from a growth perspective, not great, because you cannot really deploy capital when you're supposed to preserve capital, and you have to reprice your deposits at a higher level. So I would say not terrible, roughly stable. I wouldn't say better than 2023.
Okay. Let's hit some audience questions, right?
Yeah.
And I see one that I have to ask because I'm in the regional bank space. So I really want to get your opinion on this one. And it's a great question, right? It's where's the capital going to come from to fund consolidation in the regional bank space? And kind of having in the context as well, I mean, if we look at, we'll call it M&A in regional bank space now, so many of us have these securities portfolios that are underwater, right? So that kind of adds to the purchase price. So well, what's your view? I mean, is it going to happen? Where's the capital come from if it does?
There are banks who are very well capitalized out there, and I just one shout to Commerce Bank. You know, we don't have a bias towards large banks only. Commerce Bank, by the way, is one of the highest rated banks in the United States, a relatively small bank. So applaud that you're doing everything right. Very strong capital and great situation in terms of their balance sheet. did not have interest rate risk. So people, you didn't have to be a large bank to have proper control over your interest rate risk, is what I'm trying to say. There's some jewels like that, and actually Commerzbank is the same rating level. By the way, it's somebody like JP Morgan and BofA, just to give you a sense. So there are banks out there who have done things well. PNC is another bank who is a large regional who is in a relatively very strong situation. So there are going to be banks out there. Fifth Third is another regional that has done relatively well so far. So, and then there are the Canadians. The Canadian banks, I mean, TD had a little bit of a flunk M&A situation in the US, but there is a large group of basically Canadians who are in very good shape, they see US as a great opportunity at the right price. They always see US opportunities very actively, but the prices were too high. So the right price, I can see the Canadians being kind of an important acquirer at the right levels, obviously within, and in a good way, because they know how to do it in the US. So I don't think it's going to happen there for the next quarter, maybe even next 2 quarters, because we still have uncertainty around economic outlook. We have geopolitical risk. We have election in the United States. They're going to drive, obviously, where we end up on Basel III. No larger bank or bank that depends on the Basel III finalization is going to jump now and decide to buy a regional bank without knowing where Basel is going to be. We understand that unless the finalization of Basel, this is sort of the rumors in DC, coming from DC, is unless finalization happens right around Memorial Day, this is going to be pushed for the next administration. There is a large push for watering down of Basel, and the large banks, particularly for the large banks, they want to see that. And then if that happens, we probably could see the first M&A in the 4th quarter, but I wouldn't say before that.
Okay. I think we have time for one more question, and this is a question that I'm glad I don't have to answer, but I'm looking forward to your response to it. And it's the first one. So banking is evolving very fast, strategies, products, growth models. Are regulators able to keep up with the changes and still add value in their conversations with banks that they regulate, or does something need to change? I know you interact with regulators frequently, but what's your view on this topic? Let me tell you, and I'm a kind of a quasi-regulator because we review risk decks with you, business strategy, et cetera. I just don't have the power, obviously, as the regulators, but we get very similar conversations. We never can know your business as good as, or any regulator can know your business as good as you. At the end of the day, which means that we never, as a regulator, can evolve. No regulator can evolve as quickly as you can evolve your business and catch up. So bottom line, to blame the regulators for where we are now in the US banking system is not probably the right way. I think we have to think about aligning and no bifurcating, weak regulatory, for example, interest rate risks, a regulation between the large banks and the small banks. But I think the regulators are trying. They're coming from the right place. They really do not want to have a hostile, obviously, a discussion with you. They want to have a constructive, but it's also part of you to build that relationship and then risk manage in your own way. They can never fix your business for yourself. Okay. And we don't have time for the Slido question, but I am curious. So in earlier conversations with Anna, I made the comment that since we had the U.S. regional bank crisis, I spend so much more time now talking to internal risk constituents. I spend much more time talking to the FDIC, the OCC, the Fed. Just please raise your hand if right now you spend more time dealing with internal risk partners and regulators than you did on a year-over-year basis. I mean, am I alone here, or are others? I'm the only one with my hand up. So I see a couple hands, but generally no, which is making me a bit self-conscious now that I have to do that more than seemingly many of you. So, okay, so we did get the Slido question up.
Much more.
Okay, so now I'm feeling a little bit better because we're 75%. Yeah. So apparently my audience is just shy.
But this is quite normal, just so you know. So there was a famous quote from a CEO of a large GSIB right after the financial crisis who said that he spent 220 days in DC. This was, I think, in 2013.
Okay.
So think about a CEO, supposed to run the business, run with the board, run your executive team. He spent 220 days in DC. So that's normal. Whenever there's a crisis, then it's going to be a little bit more outreach and overreach if it's interpreted that way. But the way to manage that is, look inward, do a lot of peer comparisons in terms of your management standards and other risk management standards. Like the bank that I'm actually presenting right after this, they are very self-conscious about, let me see that what are we doing that other banks are not doing. So the CROs being a partner of the business and thinking ahead is the way to do it rather than being a slap on the hand. Okay. So hopefully do you find this, I guess, useful? You can find me, my contacts are obviously with Andy or Baft, if you guys want me to come to any of your offsites and team to discuss kind of our outlook in a much more detail. This was sort of just a little preview of where we view, and hopefully not controversial one, and thank you for having me.
My pleasure. Thank you, Anna.
Thank you.